Welcome back, and joining me for a look at what's moved markets this week is Gary Booysen from Rand Swiss. Gary, thanks so much for joining us today. Now, things are picking up with monetary policy moves. Earnings season is in full swing, and the IMF's growth report were some of the things that were moving markets this week. Let's start off with the Fed. As expected, rates were unchanged, but Powell did dash hopes for an early interest rate cut. Do you think markets were actually just getting ahead of themselves towards the end of last year and the beginning of this year when they expected a rate cut in March?
Yeah, I think a little bit. So if you look at market pricing pre-meeting, it was actually, it was a better than even chance that we are going to get a rate cut in March. It's still the pricing has changed, slightly. When I say slightly, it's now, the expectation is there's about a 65% chance that the Fed will remain at current levels in March. But then if we move out and have a look at what's potentially going to happen at the May meeting, you're still over a 90% chance of a cut by May. So the market is clearly still saying that we're going to get rate cuts sooner rather than later, but that didn't come through in the commentary from the Fed at all. Clearly saying that they want to be very cautious. They want to make sure that the inflation path is firmly set on the way back to 2%. And yeah, certainly I think obviously throwing focus onto the data again. So today we had obviously the non-farm payrolls numbers, and really the Fed just highlighting that this is going to be a labor market story, this is going to be an inflation story, and that they don't have a growth mandate. They are not looking at this and saying, how can we try and make the US economy grow as quickly as possible? This is about price stability, and it's about full employment, and that's what they're looking for. So obviously labor numbers are key, and if you look at the US at the moment, I mean, the US labor market is still very, very strong. So it doesn't necessarily prompt a decrease. Yet, there's still, for me, there's still a big disconnect between what the Fed is saying and what the market is believing is going to happen.
From a consumer's perspective, I'm definitely crossing my fingers, crossing my toes, everything, and hoping that rate cut comes soon. Across the Atlantic, the Bank of England also kept rates unchanged. Policymakers on that end ditching a previous warning that rates could rise and opening the door for rate cuts. Gary, the situation in the UK is quite different as it's dealing with a lot of domestic issues. What have you made of that move in particular?
Yeah, I think central bank movements are largely correlated. So you said you're crossing your fingers and crossing your toes that rate cuts are coming in, and if rate cuts come in the US, they're going to feed through into the UK, and they're going to feed through into South Africa, because we've got to essentially, to an extent, protect our currency, because otherwise we will import inflation, and the same is just as applicable with the Bank of England. So yes, they're facing a very different situation to the US situation on the ground. They're still in the throes of I suppose the aftershocks of Brexit as well in the UK, and it's a tough environment. Europe is a very different beast compared to the US, and yes, it kept its benchmark rate unchanged at 5.25%, but inflation is moving in the right direction there. So I think after we've had a very unusual period, and I think that's important for viewers to understand. We've gone through COVID, we've had a lot of geopolitical tension that has disrupted supply chains, but the commentary that you're getting from central banks is that supply chains are healing, and this is helping to reduce inflation. So they will be able to be more accommodative. But for now, Bank of England also going with the wait and see approach.
You're right, definitely data dependent. Things are looking better, but there's still some upside risk to inflation. We're seeing all those tensions also playing out in the Middle East, for example. Let's move over to company news. We are in the thick of international earnings season, and this week the US tech sector has been under the spotlight. That AI boom really boosting these counters. Amazon, Alphabet, Microsoft beating earnings expectations. Meta's numbers also shooting the lights out, and it declaring its first dividend. Apple, on the other end, delivered upbeat numbers, but investors are concerned about sales in China. Despite that hiccup, the sector is performing quite well, right?
No, an incredible sector. Last year we launched an AI-focused portfolio just to try and capture the thematic approach, and it's doing incredibly well, of course, because anything with AI in the name at the moment is doing very, very well. If you look at the sector overall, I think it's easy to lose sight of just how incredible some of these companies are when you start to get concerned about the underlying pricing. And I mean, I think Meta's numbers are probably or at least the Meta announcement is probably the one that really kind of clarifies the overall tech picture for me. If you look at Meta last year, it was the year of efficiency. We'd come off, an absolute collapse in Meta share price. Now, underneath Meta, you've got Facebook, WhatsApp, all sorts of incredible businesses that are incredibly profitable. But you have a leadership at the company that wanted to invest in, the metaverse. They want to invest heavily in AI. They want to increase that research spend. And their shareholders start to get a little bit concerned when you're going to spend a third of your market cap on R&D of something that you don't have a clear sight to profits. And I think in the AI sector, that's very, very important. But what Meta did now is I think they were just coming to market and reminding shareholders just what an incredible business some of these big tech companies are, and saying that if we just scale back that R&D slightly and we, just kind of treat our shareholders well for a change, we'll pay some dividends, we'll do share buybacks. You can see the incredible result in the share price. And for these big tech companies, it's a balancing act between the R&D that is required to keep them at the cutting edge, and then just scaling that R&D back a little bit and rewarding shareholders as well. And I think sometimes they forget to that they're also running businesses. They're too busy building the next miracle innovation. And I think Meta really made it clear that with that dividend and the share buyback that these are incredible businesses. Absolutely incredible businesses, and while they do trade on very extended multiples, the growth figures behind them, often justify those multiples as well. So, I think you look at it; it was a little bit of a mixed bag. So, I mean, analysts tend to look at the quarterly numbers. So, if you look at something like Alphabet, I mean, Google's ad revenue was a little bit behind. You saw that stock price coming off, but I said Meta stock price up significantly. It was a very mixed bag of market movements. But overall, I think, still a very, very exciting sector despite the high prices.
Just quickly, Gary, I want us to look at some corporate moves that happened locally. Canal Plus has its sights set on MultiChoice. It's looking to acquire MultiChoice. This, of course, comes after it increased its stake in the company last year to just under 32%. This move was expected, right? I mean, considering how close Canal's stake is to that 35% mark.
I think it might have been expected that a tie-up was on the cards, but the point is that the underlying pricing, was definitely a surprise to the market. And we saw that in the MultiChoice share price reaction. So a 45 billion rand deal was not what the market was expecting, because we would have seen the shares a lot higher. That said, the market is obviously still fairly skeptical because we haven't seen that discount close significantly, and there's still a lot of regulatory hurdles that the deal needs to clear. I think Vivendi and which is the hold of Canal Plus, thinking that they're going to get around this, but I mean, there are limits to voting rates for foreign shareholders. There's all sorts of hurdles that this deal is going to cross, and you can also see that in the stock pricing at the moment. Not coming up to that deal price just yet. There's a big risk premium baked into this deal, so definitely not a done deal yet, but certainly interesting and a wonderful turnaround for anyone holding MultiChoice or still holding MultiChoice after its unbundling.
All right, let's get your stock pick before I let you go.
Oh, stock pick at the moment. That's a good question. So I think I'm going to go locally. I'll go with the banks. I think Absa Bank looks pretty good at the moment, just from a valuation point of view. I think if we get even a slight bit of growth out of South Africa, or even optimism that we're going to see growth, low load shedding levels, maybe a commodity price uptick that just improves things slightly. Absa is very, very cheap compared to the other banks. In earnings terms, it's the cheapest of certainly the big four, big five banks. So I think there's a margin of safety to its underlying share price at the moment. You're getting a lot of earnings for what you're paying for it, and you just need a little bit of an increase in optimism. And despite its operational issues, I think at this price you could probably nibble and look for probably 10, 20, 30 rand upside.
Thanks, Gary, for your time and those insights. That was Gary Booysen from Rand Swiss.